Over $7 trillion has been erased from precious metals in just 36 hours. Silver is down 30% and has dropped below $85, wiping out $1.96 trillion. Gold is down 13.6% and has dropped below $4,900, wiping out $5 trillion. Platinum down 27.25%. Palladium down 21.5%. This is being called the red candle of death technical pattern. Silver just posted its worst day since 1921. That's 103 years. And here's what 99% of investors and traders out there have no idea about. They see this crash as weakness, but what we're actually witnessing is strength. So much strength that they had to carry out the most obvious manipulation in market history, because they are weaker than ever before and are fighting for survival. If you value straight macro plus metals truth over hype, hit like, share with one person who needs this, and let's build something real. Now here's the data that makes this crash absolutely insane. On first notice day for February, silver contracts, 9.4 million ounces of silver delivery notices were issued. 1,881 February silver delivery notices on first notice day. Physical silver demand is off to a roaring start for February. And this was even before Friday's 20% price smash. Let me say that again. The delivery demand was surging before the crash, not after. Wells Fargo issued 701 notices. JP Morgan issued 395 and stopped 487 notices. Macquarie issued 459 and stopped 533 notices. The banks are scrambling for physical metal. They're issuing notices. They're stopping notices. They're moving metal around frantically. And what happened to the price? It got absolutely obliterated. Now let's put this wipeout in perspective. $7 trillion erased from precious metals alone. But when you add the US stock market crash happening simultaneously, the combined total exceeds $10 trillion in the last 48 hours. That's more than the annual GDP of every country in the world, except the US and China. For comparison, this is 2.5 times the entire GDP of the UK at 3.96 trillion, 2 times the GDP of Germany at 5.01 trillion, 2 times the GDP of Japan at 4.28 trillion, 2 times the GDP of India at 4.13 trillion, 7 trillion from metals, over 10 trillion combined with stocks, gone in 48 hours. And here's what makes this absolutely insane. Silver fell as much as 35% during intraday trade. That's the largest intraday drawdown in history. Yet silver prices still closed the month green, rising 19%. This means silver has now risen for 9 straight months. History is an understatement. And here's what you need to understand. Shanghai spot silver is currently at $122. COMEX closed at $85. The Shanghai premium is $37. That's a 43.5% premium. Physical silver in China is trading 43% above COMEX after a 30% crash. The premium didn't compress. It didn't disappear. It's still massive. Why? Because the physical market is not following the paper market. Now, before we go further, let me address 2 different audiences watching this right now. Most of you who are long-term physical stackers, you're actually enjoying this. You're seeing this 30% crash as either the buying opportunity you've been waiting for, or you're planning to stack even more if it drops further. Your time frame isn't daily, it's weekly, monthly, even yearly. The volatility doesn't shake you because you understand the physical fundamentals haven't changed. You're relaxed. You know the bigger picture. Lower paper prices with a $37 Shanghai premium. That's exactly what you want to see. The disconnect between paper and physical is widening, not closing. You're stacking more, not less. But some of you are short-term traders and you're in full panic mode right now. A 30% crash in 36 hours with high leverage. That's a liquidation nightmare. I've been warning about over-leverage for weeks. I've said it in video after video. And if you didn't listen, this move destroyed you. You're watching these technical levels because you're in and out of positions. You're managing leverage, stops, entries, exits. And if you were on the wrong side or over-leveraged, margin calls already hit. Forced liquidations don't care about your thesis. The technical roadmap I'm providing helps you navigate this volatility without getting completely wrecked. The relaxed, long-term view that sees the bigger picture and the active, short-term trading that requires precision. Know which one you are and trade accordingly. I've always covered both sides on this channel, bullish and bearish, optimistic and cautious, because the goal is unbiased information that empowers your own improved decision-making. Unfiltered, raw truth delivered without fear or greed. So let's connect the dots on what actually happened here. Silver posted its worst day since 1921, the red candle of death. 1.96 trillion in market cap erased. Everyone is calling this a technical breakdown, a liquidation cascade, proof that the precious metals bull market is over. But look at what's happening on the physical side. 9.4 million ounces of delivery notices on first notice day. That's massive. That's before the crash. The banks are issuing and stopping hundreds of contracts each. Wells Fargo 701 issued, JP Morgan 395 issued, 487 stopped. These aren't small numbers. These are banks scrambling to manage physical exposure while the paper price is getting destroyed. Connect the dots. If physical demand was weak, if the fundamentals were breaking, why would delivery notices be surging? Why would the Shanghai Premium be holding at $37? Here's the reveal that reframes everything. This wasn't a breakdown. This wasn't even a correction. This was a deliberate paper slaughter. The sharp drop we've seen, gold down 10%, silver plunging 30%, wasn't a normal market move. It was triggered by massive sales on the paper futures markets by major banks. No new physical ounces of gold or silver were created by this move. The fundamentals haven't changed. Investment buying remains strong, especially in physical bars and coins. Central banks will continue to buy gold. Silver supply is still tight. Mine output grows slowly while above-ground stocks get drained. Industrial demand for silver stays red hot. Solar, electronics, EVs, and more keep pulling metal off the market. This crash in the price of silver is not normal, with no real changes to demand and supply over a 12-hour period. What you're witnessing is corruption. Financial regulators and market operators are not in control of major banks who continue to manipulate world markets. The physical market was tightening. Delivery demand was exploding. Shanghai premiums were widening. COMEX inventories were draining. The system was on the edge of a squeeze, and they panicked. They unleashed the most obvious manipulation in market history to reset the paper price and shake out weak hands before the squeeze could accelerate. Think about the timing. 9.4 million ounces of delivery notices before the crash. That's physical demand screaming deficit. Then suddenly a 30% crash in 36 hours. The worst day since 1921. And after the crash, the Shanghai Premium is still $37. The physical market didn't panic. The physical buyers didn't disappear. They're still there. Still bidding. Still accumulating. Only the paper price collapsed. And here's the other catalyst nobody is talking about. Polymarket is pricing an 85% chance of a U.S. government shutdown by January 31st. That's tomorrow. 85%. And if you forgot what a shutdown really does, look at 2025. 43-day shutdown. 2.8% GDP hit. 34 billion gone, 670,000 federal workers sent home. That's real damage. Democrats are weaponizing the Minneapolis Border Patrol shooting to block the DHS bill on the Senate floor. DHS funding is the fuse. If DHS stalls, you get a partial shutdown clock ticking into the deadline. And a shutdown isn't just people staying home. Paychecks get delayed, contracts get delayed, approvals get delayed, data gets delayed. The economy slows from pure uncertainty. Markets are not pricing this right now, but they will. The market reaction to shutdowns is always the same. Bonds move first, stocks react later. Crypto gets the violent move, and precious metals, they get sold initially as people scramble for liquidity. Then they rip higher as the safe haven bid returns and the Fed is forced to ease. We're seeing the first phase right now, the liquidation, the panic, the 30% crash. But here's what's absolutely insane. Silver fell as much as 35% during intraday trade today. That's the largest intraday drawdown in history. Yet silver prices still closed the month green, rising 19%. This means silver has now risen for 9 straight months. 9 straight months green, and they're calling this a broken bull market. The setup for the rebound is being built in real time. Now let's address the bearish case because a 30% crash in 36 hours, the worst day since 1921, is not something to take lightly. This is brutal. If you were trading on leverage, you got liquidated. If you had tight stops, you got stopped out. If you were over-positioned, you're underwater. The technical damage is severe. The red candle of death is a legitimate breakdown pattern. And here's the other risk. If the government shutdown actually happens tomorrow, if we see 43 days like 2025, the economic damage could keep pressure on risk assets, including precious metals. The initial reaction to shutdowns is risk-off, liquidations, flight to cash. It doesn't matter that gold and silver are safe havens. In the very first stage of a crisis, everything sells as margin calls hit and liquidity dries up. The paper market can stay irrational longer than most traders can stay solvent. We just saw $7 trillion erased in 36 hours. There's no guarantee it stops here. We could see more selling, more liquidations, more panic. If you're trading this on margin, this environment is a meat grinder. Even if the long-term thesis is correct, the short-term volatility can wipe you out before the turn comes. But here's why the bearish case for paper doesn't change the bullish case for physical. 9.4 million ounces of delivery notices on first notice day before the crash. That's not speculation. That's verifiable COMEX data. Wells Fargo 701, JP Morgan 395 issued, 487 stopped. The banks are scrambling for physical while the paper price craters. That divergence is historically unprecedented. Shanghai premium $37 after a 30% crash, 43% premium. In normal markets, premiums compress or disappear during crashes. Physical sellers panic and flood the market. Premiums go negative, but not this time. Shanghai is holding at 43% over COMEX. Physical buyers in China are paying nearly 50% more than paper traders in New York. That's not a broken bull market. That's a rigged paper market losing credibility. The delivery demand was surging. The inventories were draining. The premiums were exploding. The squeeze was building. And they hit the panic button. They crashed the paper price 30% in 36 hours to shake out weak hands, trigger margin calls, and reset positioning before the physical reality overwhelmed the paper system. This is the most obvious manipulation in market history because they had no other choice. They're fighting for survival. So where does this leave us? 3 key takeaways, and we're out. Number 1. Silver just posted its worst day since 1921, down 30% in 36 hours, wiping out 1.96 trillion. But 9.4 million ounces of delivery notices were issued on first notice day before the crash. Wells Fargo 701, JP Morgan 395 issued and 487 stopped. The physical market is screaming deficit while the paper market crashes. That divergence is the story. Number 2. Shanghai premium is $37. 43% above COMEX after a 30% crash. In normal markets, premiums disappear during liquidations. Physical sellers panic. This time, the premium is holding. Physical buyers in China are still paying nearly 50% over paper. And here's the kicker. Silver fell 35% intraday but still closed the month green, up 19%. That's 9 straight months of gains. The fundamentals haven't changed. Investment buying strong. Central bank buying continues, mine supply tight, industrial demand red hot. This creates a solid floor quickly. The physical market is not following the paper market down. The disconnect is widening, not closing. Number 3. 85% odds of a government shutdown tomorrow. 43-day shutdowns cause 2.8% GDP hits, delay paychecks, contracts, approvals. Markets aren't pricing this yet. Initial reaction to shutdowns is risk-off, liquidations, flight to cash. That explains the timing of this crash. But shutdowns also force Fed easing and safe haven flows. The rebound setup is being built right now. The unresolved tension is this. We just saw the worst silver day since 1921, but delivery demand is surging and premiums are holding. Does the paper market continue crashing and take us lower? Or does the physical reality reassert itself and force a violent snapback? And with an 85% chance of government shutdown tomorrow, how does that catalyst play into the next move? 7 trillion erased. Worst day since 1921. Red candle of death. Everyone sees weakness. But 9.4 million ounces of delivery demand, $37 Shanghai premium, and banks scrambling for physical tells a different story. They panicked. They unleashed the most obvious manipulation in history, and the physical market is telling you they're fighting for survival. Do your own due diligence. Understand the risks. If you're trading on leverage, this volatility is a liquidation machine. 30% crashes wipe out over-leveraged positions instantly. But if you understand what's actually happening, physical demand surging, premiums holding, banks scrambling, then you know this crash is not about fundamentals. It's about desperation. Invest with logic, not hype.